This begins a video where we're going to have a brief discussion of the accounting for exchanges of monetary assets. Now, you remember from your accounting studies, monetary assets are those type of assets that can be converted to a precise dollar amount in a very short amount of time. And everything else is a non-monetary asset. And for our purposes, that's going to include things like intangible assets, plant, property, and equipment, items like that. Now, businesses on occasion will enter into an exchange agreement where one business will exchange one monetary asset for the non-monetary asset of another business. Probably the easiest way to think about this would be a company that is giving up a machine for another machine owned by another company. Why that would happen, there's a variety of different reasons. We don't need to go into those, but we need to know that I shouldn't say many times, but sometimes businesses do go through exchanges of one monetary asset for another monetary asset. Before we talk about the accounting of non-monetary assets, it's best if we go through some of the terminology and make sure we have an understanding of the terminology. So let's start off with the term exchange. An exchange is a mutual transfer of assets, or as it says here, a mutual transfer of the ownership of assets between entities, generally of equal value. Now, it doesn't mean that the value that is transferred has to be equal value, but generally it is of equal value. Now, each respective party to the exchange gives up the rights to the risks and rewards associated with the asset that they've exchanged. Now we're going to talk about monetary assets, and the reason we're going to talk about monetary assets is it helps define non-monetary assets. So let's talk about the term monetary assets. Monetary assets are money or a claim to receive a sum of money, the amount of which is fixed or determinable without reference to future prices of specific goods or services. Includes, but is not limited to, cash and cash equivalents, accounts receivable, and notes receivable. Okay, with that information in mind, let's talk about non-monetary assets. Okay, all assets that are not monetary are non-monetary. Okay, now non-monetary assets are assets where it is not possible to precisely determine a dollar value for that asset. And the dollar value may fluctuate over time, and these type of assets are not readily or easily convertible into cash or cash equivalents. Now, these type of assets include, but not limited to, intangible assets, and those would include things such as copyrights, design patents, goodwill, etc., and tangible assets, which would include property, plant, equipment, inventory, and also we could say etc. The last term is what we call boot, and most of you should know the term boot if you've had business law. But boot means something extra given in a bargain, into a bargain. In terms of commercial law, boot refers to an additional amount given to make up the difference in an exchange that is of similar nature, but it's unequal in value. So if you're trading an asset that is significantly less in value to the asset that you're being traded, typically you're going to be including some form of boot, which would be, let's say, a cash payment that would bring up the value of the lower value asset up to the value that be approximately equivalent of the asset that you're receiving. Okay, let's look at the basics for an exchange of non-monetary assets. So again, exchange is mutual transfer of the ownership of non-monetary assets between entities. Now, if the fair value of the assets being exchanged can be identified, the exchange will be considered a monetary exchange. So in a monetary exchange, assets that are transferred will be measured at fair value. Now, what that means is assets transferred to the transferee will be valued at the fair value of the asset given up by the transferee. After that, then, based upon the transfer, we will recognize a gain or loss immediately on the exchange, and we'll have a gain or loss if fair value does not equal the carrying value of the asset. Now, there is an exception provided to the valuation of fair value valuation, and that's basically we can use the fair value of assets being received if there's clear evidence the fair value of the asset being received should be used instead of the fair value of the asset being transferred. But typically it's accounted for, the fair value of the asset being transferred in is valued at the asset value that you've basically given, that the transferee is given up in the process. You'll recall in our previous slide that we had a very simple depiction of the process of valuing and recording a non-monetary exchange. Typically, non-monetary exchanges are recorded at the fair value of the assets exchanged. Now, there are exceptions to that, and we will talk about those in a few minutes. But let's summarize the typical exchange that is recorded at fair value. Under those conditions, or under these conditions, assets received from the other party will be valued at the fair value of the assets that have just been given up. In addition to that, a gain or a loss will be recognized immediately upon the exchange, and that's whenever the fair value does not equal the carrying value of the asset. So that will result in a gain or loss. Now, there are situations where what boot is included as part of the exchange. Boot is typically cash, and cash is typically given to another party when the value of the assets being exchanged aren't necessarily equal. So the party with the assets with the lesser value may provide the other party some form of compensation to make up for the differences in fair value of the assets. Now, if that's a condition, our accounting changes a little bit. Okay, for the party giving the boot, in other words, let's assume giving up cash in the exchange, assets received from the other party will be valued at fair value of the assets that we've given up, plus the amount of the boot that we've given up. In the case of the party receiving the boot, assets received will be valued at the fair value of the assets given up minus the boot received. And also, we're going to have a gain or loss, which will be recognized immediately on the exchange if our fair value differs from our carrying value. Now, as I mentioned, there are exceptions to the fair value treatment, and it's good to know what these exceptions are. The first exception is what we said, or what is called the fair value of the exchange is not determinable. What that means is that the fair value of the assets being exchanged cannot be readily determined. Another exception is where there's an exchange of assets to facilitate sales to customers. And third is an exchange of assets where the transactions involved lack a commercial substance. Now, to define commercial substance, the FASB says cash flows are virtually unchanged after the exchange. In other words, there's a question as to why the assets were even exchanged if there's no economic difference as a result of the exchange. So if that is the case, basically the transaction lacks commercial substance. Now let's go down to the situation where the fair value of the exchange is not determinable. Okay, if that's the case, then we record the exchange at the carrying value of the assets being given up. No gain or loss is recognized in this transaction. Okay, now in all the other cases when we have exceptions, then we can say fair value is determinable. And let's assume that in one of these exception transactions that no boot is given. In other words, nothing extra is included, no extra incentive is included in this transaction. So in this case, we record the exchange for both parties, record the exchange at the carrying value of the asset that they're giving up. Now, no gain is recognized as a result of this transaction. However, if the carrying value is greater than the fair value, we would recognize a loss in the exchange. Now let's assume that the exchange involves boot. Okay, if we are the entity that gives the boot, we record at the, and I say BV, that should actually be carrying value. Book value is the same thing as carrying values we talked about before, but we record at the book value, we record at the carrying value of the asset given plus the boot that was given in the transaction. Again, no gain is recognized. However, if we do have a loss where the carrying value is greater than the fair value of the asset, we can recognize, and we would recognize, a loss. Now, if boot is given, it's going to be received by the receiving party. So if we have boot received, what happens? The receiving party's accounting is going to be a little different. We're going to record the asset at its carrying value. Again, I put down book value, but that should be CV for carrying value. So we want to record the asset at its carrying value, basically we want to record the asset at the carrying value of the asset that we've given minus any boot received plus any gain that we may recognize as a result of that boot being the portion of the gain, a portion of the gain being allocated to the boot. And we'll see how that works a little bit later on. Now let's take a look at an example of recording an asset where assets are going to be transferred. They're going to be measured at their fair value. In effect, the asset acquired will be recorded at the fair value of the asset that we're giving up. And again, if there's any gain or loss, it will be recorded immediately wherever the fair value differs from the carrying value. So let's take a look at how these transactions are recorded. Okay, we have two companies. We have Company A and we also have Company B. And we have the assets that they're going to be exchanging in the transactions. We have the assets cost. We have the associated accumulated depreciation with the asset. We also have computed the carrying value of the asset. That's what I've done in that slightly grayed out font. And also we have the fair value of the assets being exchanged. So A is going to exchange assets with B, and obviously B is going to exchange their assets with A. So in this case, the first thing we need to do is determine what is the value of the new asset for, let's say, Company A. And again, what we say is the value of the value of the asset of this new asset is going to be equal to the value of the asset that we've given up. So the value of the new asset is $250,000, which is equal to the fair value, the fair value of the asset that we've given up of $250,000. In addition, we have to remove the accumulated depreciation that is associated with the old asset, the $150,000. We also have to remove the old asset that we've given up, which had a cost basis of $280,000. And finally, then we record a gain or loss on the exchange of the equipment. In this case, we see we have a fair value of $250,000, and we subtract away the carrying value of that asset, which is $130,000, which leaves us with the gain on the exchange of $120,000. Now let's move on to Company B and see the impact on the exchange with Company B. So again, what we're going to do is we're going to establish the value of the new asset. And as I had mentioned before, the value of the new asset is equal to the fair value of the asset Company B has just given up. So the fair value of that asset that they've given up is $275,000. So I'll record that as $275,000. I also then remove the accumulated depreciation associated with the asset that I've given up of $160,000. Also, I remove the asset that I have given up as a cost from the books of Company B, $300,000. And I record a gain on the exchange of equipment, which is based upon the fair value of the asset given up minus the carrying value of the asset of $140,000. And the difference between the two is $135,000, and that is the gain. Okay, now let's take a look at a similar transaction to the previous slide, but in this case, the company is paying boot. And we can see we have Company A and Company B again, and Company A will be exchanging assets with B, B with A. The difference is that Company A is also paying Company B $25,000 in cash, or a legal term in boot. So let's take a look at the accounting for Company A. So we take the new asset. We know its fair value that we have given up is $250,000, just like the previous slide. But in addition to that, we add $25,000 to the new asset, which represents the boot that we have basically spent or given up in transferring that asset. So the total, it comes out to $275,000. Then our accumulated depreciation, again, it is the same, $150,000. The asset given up is $280,000, just as it was before. And the cash is $25,000 in this case, where we gave up the cash, or we used the cash. And we calculated our gain on the exchange of equipment, which happened to be the $250,000 fair value of the asset minus $130,000 carrying value. That equals $120,000. Now let's take a look at Company B, and again I'll change to a different color marker here. But in this case, in valuing the new asset is the value of the asset you've given up, in this case plus, or in effect, you're going to also, company B is receiving the boot. So what's going to happen is it's going to be the $275,000 of the asset they've given up minus a $25,000 boot. So the new asset value is going to be $250,000. Accumulated depreciation on the asset given up $160,000. The cash that we received, $25,000 in cash. Asset given up $300,000, and the gain on the exchange of the equipment would have been $135,000, which is the $275,000 fair value of the asset minus our $140,000 carrying value. That equals $135,000. Now let's take a look at one of the exceptions to fair value treatment. And it is where the fair value of the exchange is not determinable. And what the entities are going to do, they're going to record the exchange at the carrying value of their assets. And also, no gain or loss is going to be recognized as a result of this exchange. Now again, we have company A and we have company B, and we have the company cost, the cost of the company assets being exchanged, the accumulated depreciation. We also have the carrying value, again in the grayed out font. And in this case, we don't have any fair value because in this case, the fair value of the assets cannot be determined. So under these circumstances, then the exchange assets are recorded at their carrying value. So in this case, when we take a look at company A, the new asset will be recorded at the carrying value of the asset company A is giving up. That will be the $100,000 carrying value. We are then going to debit the $400,000 accumulated depreciation to remove that from our account, our accumulated depreciation account to remove that. And we're also going to credit the cost of the asset for $500,000 to remove that cost from our account. Company B, on the other hand, is going to do company B is going to do the same thing. The value of the new asset will be $250,000, which is the carrying value of the asset that they're given up. We then debit against our company B's books, debits the $150,000 of depreciation that's associated with the company B asset given up, and also the $400,000 cost of the asset given up. And that's the end of that makes this transaction actually pretty simple. Now let's take a look at an example of another exception to the fair value treatment, and that's where the transaction lacks commercial substance. And again, that's where cash flows are virtually unchanged after the exchange. Again, over on the right-hand side, you can see the matrix here that has the company assets that are going to be exchanged, their accumulated depreciation, and their fair value between company A and company B. And this should be company A exchanges assets with company B. Now, in this case, let's assume that company A enters into this non-monetary exchange with company B in a transaction that lacks commercial substance. In that case, then, the exchanged assets are recorded at their carrying value. Now, no gain is recognized as a result of this exchange. However, if the fair value is less than the carrying value, a loss would be recognized, and we'll see that recognition on the next slide. But let's assume right now we have these facts. And in this case, we would value the new asset at the carrying value of the assets that we have given up, and that would be $100,000, which would be the carrying value, again, of the asset that we've given up. We would remove the $400,000 of depreciation from the books and also the $500,000 asset that we've given up. Now, there can be situations where we can enter into a transaction like this, and the one company will pay some form of boot to another company to make up for the differences in the possibility, the value of the exchange. So here we're going to, again, this will be a transaction that lacks commercial substance, but we're going to assume company A pays $50,000 in cash or boot, in effect, in addition to the non-monetary exchange. So in this case, again, we're going to value the asset at its carrying value, but we have to adjust it for the boot that we've given up. So the new asset will be valued at the $100,000 carrying value plus the $50,000 worth of boot that we have given up as part of the exchange. So the new asset will be valued at $150,000. Again, we'll debit our accumulated depreciation for the $400,000 and credit the asset cost for $500,000 to remove the asset cost from the books. Also, we include cash of $50,000, which represents the amount of cash we've paid as part of the boot of the transaction. Crap. Let's take a look at multiple choice question number 1 of 3. So we have a company here called Zorlock Industries and another company called Vandelay Company, and they entered into an agreement to the exchange of 2 machines. The machine that Zorlock was transferring to Vandelay had a cost of $280,000 and an associated accumulated depreciation of $150,000. The machine at the time of the transfer had a fair value of $250,000. Now the machine that Vandelay was transferring to Zorlock had a cost of $300,000 and accumulated depreciation of $160,000. And the Vandelay machine had a fair value of $250,000. So the question is, what is the gain to Vandelay on the transfer, assuming the transaction had economic substance? So we're given 4 different scenarios. Go ahead, stop your video, do your computations. When you're ready, restart the video and take a look at the answer slide. Let's take a look to the answer to question number 1. And again, the question is, what is the gain or loss to Vandelay on the transfer, assuming the transaction had economic substance? Okay, in this case, if we take a look, the answer would be C, $110,000. And let's see how we calculate that. Okay, again, the calculation for the gain or loss would be the fair value of the asset given up minus the carrying value of the asset. So we can do that computation. The fair value of the Vandelay machine that was transferred would be $250,000. And the carrying value of the Vandelay machine that was transferred would have been its cost of $300,000 less its accumulated depreciation of $160,000. So its carrying value is $140,000. So the $250,000 fair value less the carrying value leaves us with a $110,000 gain. Okay, let's go on to question number 2, and it's somewhat of the same question format as the previous question, but there's some different numbers and a different real final question. And Zorlock Industries and Vandelay Company entered into an agreement to exchange 2 machines. The machine that Zorlock was transferring to Vandelay had a cost of $200,000 and accumulated depreciation of $20,000. The machine had a fair value of $150,000. The machine that Vandelay was transferring to Zorlock had a cost of $300,000, accumulated depreciation of $150,000, and the machine had a fair value of $150,000. So what is the gain or loss to Zorlock on the transfer, assuming the transaction in this case had no economic substance? So again, we're given 4 different choices. Go ahead and stop the video, do your computations, and when you're ready, restart the video and review the answer. Okay, with number 2, the question is, what is the gain or loss to Zorlock on the transfer, assuming the transaction had no economic substance? So in this case, let's take a look. Again, if we look at the fair value of the machine, in this case that Zorlock transferred, that would have been $150,000. The carrying value of the machine transferred for Zorlock was going to be $200,000 cost minus the $20,000 of accumulated depreciation. So the carrying value was $180,000. In this case, the carrying value is greater than the fair value, so there would be a loss on the exchange. And remember, in this case, if we have a loss, we would record the loss on the exchange, in this case C, $30,000. If we had a gain on the exchange, since it has no economic substance, we would record no gain, but we would record the loss. Let's take a look at question number 3 and the final question in our exchange of monetary assets video. Have a company called Timbuktu, and they exchanged a truck, and the truck had a carrying value of $12,000 and a fair value of $20,000. And Timbuktu exchanged their truck for another truck plus $2,500 in cash. So Timbuktu also received $2,500 in cash. The fair value of the truck that Timbuktu received was $17,500. Now, we're told that this exchange has no commercial substance. At what amount should Timbuktu record the value of the asset that was transferred in? Again, we're given our choices. Go ahead, stop the video, and when you've done your computations and you're ready, restart the video. Okay, for number 3, the question is, at what amount should Timbuktu record the value of the asset transferred in? And the correct answer in this case is C, $10,500. That requires several computations, so let's go ahead and go through this process. Again, normally an exchange that has no commercial substance results in the exchange of assets at their carrying value. And again, typically no gain or loss is recognized unless, okay, the fair value of the asset given up is less than the carrying value of the asset given up, or the transaction may result in an exchange gain for the party receiving the boot. And in this case, that is the case in this particular problem. So we start out with the fair value of the assets received. That includes the $17,500 value of the truck that we're receiving, plus the $2,500 of cash, the boot, $2,500. So that means the fair value of the assets that we're receiving are $20,000. Okay, now we have to determine what the gain is going to be on this transaction. Okay, the fair value of the truck that we're giving up is $20,000. Okay, the $20,000 less the $12,000 of the carrying value of the assets that were given up. That means we're going to have an $8,000 gain in this case. Now, the portion of the gain, we're only going to recognize a portion of the gain. And the way we do that is we take the $8,000 gain and we recognize the portion that pertains to our of the total gain computation that pertains to the boot. So that's the $2,500 of cash that we received divided by the fair value of the assets that we received in the transaction. And if we do that calculation, that's going to that apportionment will then mean that we recognize $1,000 of the gain. So the value of the asset received then will be the $12,000 carrying value of the asset that we have given up, plus the $1,000 gain that we recognized, minus the $2,500 in cash that we received. So the value of the assets received, the new assets, will be $10,500. And with that, that is the end of our module, or of our video on the exchange of non-monetary assets.